Welcome back to the Deep Dive. Today we're focusing on something that's often seen as the backbone of global finance: bonds and fixed income investments.
Right.
It's an asset class that, on the surface, sounds incredibly simple. You loan some money, you get some interest back.
Yeah, that's the gist of it.
But the mechanics behind it all are surprisingly complex, and they're absolutely crucial for anyone who is, managing serious wealth.
It's so true. Bonds, they rarely grab the headlines the way stocks do, but they are the essential bedrock of a portfolio.
The shock absorber.
Exactly. The shock absorber, the engine for generating dependable income, and really the main tool for balancing risk, especially when markets get turbulent.
So our mission today is to cut through all the jargon. We want to understand not just what a bond is, but how it actually behaves, specifically how its price reacts to interest rates, how we measure that sensitivity, and, at the end of the day, how fixed income supports your long-term investment strategies. This is the deep dive into the defensive line of your financial plan.
Okay, so let's start with the absolute fundamental definition. Forget all the fancy names like security or note. A bond is, at its core, a contractually obligated loan.
A loan. Simple as that.
Simple as that. When you buy one, you're lending money to the issuer. That could be a huge corporation, a local government, or most commonly, a national government.
And what's the reward? Why am I giving them my capital?
You get two things. First, you receive interest payments, we call them coupons, on a very regular schedule. And second, and this is crucial, when the loan's term ends at maturity, the issuer pays you back the bond's full face value, the principal.
And that predictability is what really separates it from owning a stock.
That's the fundamental distinction.
Right.
Owning stock gives you a slice of ownership and, unlimited upside, but also
limited risk of loss.
Exactly. Bonds, on the other hand, they define the terms right up front. They promise predictable returns, more stability, a clearer income stream. But, and this is so important to get, that stability is relative. It means a specific set of risks, not zero risk.
Okay, so let's look at who you're lending this money to. Starting at the lowest end of the risk scale, we've got sovereign debt. In the UK, we famously call them gilts.
Gilts are really the gold standard for minimal credit risk because they're backed by the government's power to tax. The risk of them just not paying you back of a default is seen as extremely low.
They provide that foundation of safety.
That's it. It's the foundation every multi-asset portfolio really needs.
But safety doesn't mean the price is static, right? Even government bonds, which everyone assumes are just rock solid, their prices still fluctuate.
Absolutely. The default risk is tiny, but the market risk is still very much there. Their prices are constantly moving based on these big economic forces, mostly expectations around future interest rates, inflation.
And just general market sentiment.
And global market sentiment, yeah. They're stable compared to stocks for sure, but they are certainly not bank accounts.
Okay, so moving up that risk and return ladder, we get to corporate bonds. Now we're lending money to a specific company, and the complexity, I imagine, just ratchets up immediately.
It does, because corporate bonds offer higher potential returns for one reason. They carry higher risk. Here, the crucial factor is the financial health of that company. Is this a blue chip giant with tons of cash?
Or is it a newer company that's taken on a lot of debt?
Precisely. And the answer to that question determines the interest rate they have to offer you to make it worth your while.
This brings us to the whole idea of a credit quality spectrum. How do we, as investors, even begin to assess that financial health?
Well, that's where credit ratings agencies come in. You've heard of them: Moody's, S&P, Fitch. They step in and assign these letter grades based on the company's ability to repay its debt.
And the really strong companies, they issue what we call investment-grade bonds.
Yes, investment grade. Those carry lower interest rates because the default risk is seen as very low.
But then we get to the other end of the spectrum, the juicy part where the returns jump up, but the risk profile looks a lot steeper.
That's the high-yield market. It has a notorious nickname: junk bonds. These are bonds issued by companies with weaker financials. Maybe they're facing some specific challenges. So they have to offer significantly higher coupon payments to compensate you, the investor, for that elevated chance they might go bust before they can pay you back.
So if I see a bond offering, say, 8%, when government bonds are only offering 2%, that 6% gap, that's basically the market pricing and the likelihood of that company failing.
That is exactly what it is. That extra percentage you earn is called the credit spread. It's the premium you demand for taking on that credit risk. Understanding this whole spectrum, from rock-solid gilts to speculative high-yield debt, is really step one.
Okay, if there is one concept, one piece of knowledge that just defines bonds, it's the mechanism of pricing. This is the idea that unlocks everything else.
This is the aha moment for fixed income. It's the inverse relationship between interest rates and bond prices.
Okay, let's unpack this one carefully because I think it's the most misunderstood concept in all of finance. If a central bank raises interest rates, let's say from 2% to 4%, why does the price of a bond I already own, one that's still paying me only 2%, suddenly just plummets?
Okay, think of the bond you're holding as an old car. It has a fixed feature. That 2% coupon payment, it's welded on. Suddenly, the entire dealership starts selling brand new cars, new bonds, with a much better feature, a 4% coupon.
Okay.
No rational buyer is going to pay full price for your old 2% car when they can get double the interest on a brand new one right next to it.
So for anyone to even consider buying my old bond, its price has to drop. It has to drop low enough so that the total return a new buyer gets is competitive with that new 4% bond.
Exactly. When the market price falls, its yield rises to match the current rates. And, the reverse is true too. When rates fall, your older bond with its high coupon becomes a treasure, and its price gets bid up. This dance is happening constantly.
That makes so much sense for how prices move. But how do we quantify how much they move? That brings us to a metric advisors are always talking about: duration.
Right. Duration is the technical measure of a bond's sensitivity to those interest rate changes. It's expressed in years. And the rule is simple. The higher the duration number, the more volatile you can expect the price to be when rates change.
Hold on. If duration is measured in years, why doesn't a 10-year bond just have a duration of 10?
That's a great question. It's because duration didn't just measure time to maturity. It measures the weighted average time it takes for you to get all your cash back, and that includes those coupon payments.
So because you're getting some money back along the way from the coupons, the effective time is a bit shorter.
You've got it. The effective duration is always a bit less than the time to maturity.
So here's the practical takeaway then. If I hold a 30-year bond, its duration is going to be really high. If the central bank suddenly hikes rates by 1%, that bond's price could drop, maybe 15% overnight?
That's the risk. The longer you have to wait for that final principal payment, the more sensitive the bond is. A short duration bond, say one maturing in 6 months, it barely moves because you're getting your money back almost immediately anyway.
So duration is the ultimate strategic lever. If I think interest rates are headed down, I should be buying long-duration bonds to capture those future price gains.
That's the speculative play, yes. But if you're purely focused on managing risk and you expect rates to go up, you shorten your duration dramatically to protect your capital. It's the main dial we turn.
Okay, before we move on from pricing, let's just quickly clarify one more thing that always confuses investors. Yield versus coupon rate.
Yes. The coupon rate is the easy one. It's the fixed interest rate the issuer promises when the bond is first sold. It's printed on the contract. It never changes.
If it says 5%, it's always 5%.
It's always 5%. The yield, however, is a moving target because it depends entirely on the current market price of that bond.
So the yield reflects the actual return you're getting relative to the price you paid for it.
Precisely. If you buy a 5% coupon bond, but you only pay $800 for it, instead of its $1,000 face value, your effective yield is going to be way higher than 5%.
Because you get a built-in profit at the end.
Exactly. When prices fall, yields rise. When prices rise, yields fall. They're two sides of the same coin, but only the yield tells you your true current rate of return.
Okay, so we've established stability doesn't mean zero risk. Let's dig into those risks, starting with credit risk, the chance the issuer just fails to pay.
This is everything in the corporate bond market. We use those ratings agencies, Moody's, S&P, to classify the risk. Investment-grade bonds are generally rated from AAA down to BBB. These are seen as financially solid companies.
And what happens when a company starts struggling and its rating dips below that BBB level?
Then that falls into the non-investment grade category, the high yield or, the junk market. And that transition can be really dramatic. When a big, previously stable company gets downgraded, its bonds are sometimes called a fallen angel.
I've heard that term.
Yeah, the price just drops off a cliff, the yield spikes, and suddenly that bond is trading based on a much higher perceived risk of default. This is where you absolutely need deep research.
I think the second big risk is the one that most people just don't think about: liquidity risk. Everyone assumes if you buy something, you can sell it immediately.
And that's a dangerous assumption. It's mostly true for things like major stocks or government gilts. But the bond market is often very fragmented. Liquidity just means the ease of trading without wrecking the price.
So if I own a corporate bond from some small regional company and I need to sell it in a panic, I might not find a buyer.
You might find one, but because there's so little trading volume, you might have to slash the price just to get someone to take it off your hands. That's liquidity risk eating into your return. It gets especially bad during a market crisis.
Okay, let's pivot to strategy. Why do we even bother with all these risks when equities, historically, offer such great long-term growth? What's the strategic role of bonds?
The most famous role is just diversification and stability, that smoothing effect. Bonds tend to behave very differently from equities when stocks are in a panic.
High-quality government bonds often hold steady or can even go up.
Exactly. That's the counterbalance. I mean, think back to 2008 or the crash in 2020. High-quality sovereign debt was a crucial shock absorber.
And that stability, it reduces the overall portfolio drop, which helps you avoid panic selling at the worst possible time.
That's a huge part of it. It's behavioral. Bonds help you stay disciplined and keep your eyes on the long-term prize.
Okay, role number 2 is more straightforward. Predictable income. For someone who's stopped saving and is now living off their investments.
That steady cash flow is everything. Coupons are regular, they're predictable. It makes bonds the perfect tool for retirees. And unlike stock dividends, which a company can cut anytime,
The coupon is a contractual obligation. They have to pay it.
they have to pay it. That reliability is the foundation for secure retirement planning.
And finally, they're a key tool for risk management as you go through different life stages.
Absolutely. As you get older, or you're approaching a big goal like paying for college or retiring in 5 years, your objective shifts from growth to protecting what you have.
So you strategically shift money out of volatile stocks and into more defensive, shorter duration bonds.
You lock in the wealth you've built. You minimize the risk that a sudden market crash right before you need the money forces you to delay everything. It's about trading some potential upside for a much more predictable outcome.
And it's important to remember this is a huge ecosystem. Beyond just standard government and corporate bonds, there are specialized products out there.
Oh, great example is index-linked gilts, or DipFA as they're called in the US. These are designed specifically to take inflation risk off the table, which is a huge long-term worry for any fixed income investor.
How do they do that? How do they protect you?
Well, the principal value of the bond itself is adjusted upward in line with official inflation figures. So even if your coupon rate is fixed, the amount of principal it's paid on actually grows.
So your purchasing power is protected over time.
That's the goal. It's incredibly valuable for long-term planning.
And for people who just don't have the time or, frankly, the expertise to analyze every single bond out there.
The most accessible tool is a bond fund, or an ETF. You get immediate professional management and wide diversification. You buy one share, and you instantly own a basket of hundreds of bonds across different issuers, ratings, and even countries.
It just simplifies the whole complex world.
It does. It mitigates the risk of having all your eggs in one basket.
So let's try and synthesize all this for you, the listener. We've learned the inverse relationship between rates and price is the key dynamic, and duration is the ruler you use to measure that sensitivity.
And while equities are grabbing all the headlines for growth, bonds are providing the essential structure, the stability, and that predictable income stream that keeps a portfolio grounded and, frankly, manageable.
They're not just the boring part of the portfolio.
Not at all. They're the part that lets you sleep at night when everything else is going crazy.
They offer income, stability, and diversification, helping you find that sweet spot in the risk-return trade-off that's right for you.
So, to leave you with one final thought to mull over. The central trade-off here, it's unavoidable. Bonds are fantastic at preserving capital and reducing that emotional roller coaster of volatility. But that stability comes at a price and opportunity cost. You are inherently sacrificing some potential long-term growth compared to stocks. So the key question for your own planning isn't whether bonds are good or bad, it's this. How much future growth potential are you willing to give up today in exchange for maximizing the certainty and safety of the capital you already have?